Good evening, everyone. Welcome to our University of Virginia Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you tonight. Really excited to get a chance to bring this content to you. This is our second installment of 4 classes we're teaching this year for UVA as part of our partnership with the Alumni Association. So really excited that you could join us tonight. Our classes are very interactive. So as we go through tonight's content, we encourage you to ask questions. You can either use the chat function or the Q&A function in Zoom, and we'll answer those questions on air. And we'll carve out some time again at the end of tonight's class to kind of go through those questions that we may have missed. Since the Alumni Association is all across the country, it's always great to kind of get a sense of where everybody's joining us from. I know many of you are probably in the DMV area, but I would love to know kind of where you're joining us from. So if you can, just drop in the chat where you're joining us from tonight's class, and we'd love to kind of get a sense of that. It also helps me kind of understand maybe market data that might be more relevant for you as attendees of tonight's class. Now, we should have a pretty good sized class tonight, and I know we're starting right on time, but we'll allow all the rest of the guests to get into the Zoom session before we go into tonight's class. But yeah, if you could just let us know in the chat kind of where you're joining us from, that would be awesome. And by the way, all of our presentation material will be available to you tomorrow morning. In fact, we record all of our Zoom classes, and we'll have those up on our YouTube channel by tomorrow as well. So if you like to kind of look back at some of your notes or some of the recorded version, you could do that tomorrow. And we would encourage you, share some of this content with your friends, family, maybe even some coworkers that might enjoy some of this material. Well, a little bit about American Pacific Mortgage. So we're a top 10 lender in the country. We are a nationwide lender, and we were originally founded in California, but we've now kind of spread across the country. Our team in particular provides homebuyer educational workshops to various alumni associations across the country, University of Virginia being one of those partnerships. And we're really excited to bring this content to you. We're in our second year now with the University of Virginia Association, and really grateful to be a partner with them as well. A little bit about me. Not only am I your presenter and facilitator of tonight's class, but you get a chance to work with me one-on-one to build a home buying plan for you. So whenever you decide to take that next steps in home ownership, maybe after tonight's class, you'll be working directly with me to build a home buying plan for you. I do specialize in first-time home buyer programs. So whether buying in the DMV area or Texas or California, we can help support you with all of your first-time buyer resources. All right, well, a little bit about tonight's class. What you're going to learn is in our topics, we're going to kind of talk a little bit about the housing market, what's going on with it. We're going to kind of focus in on the Virginia area, but if you want to kind of give us specifics on where you're at, we'd love to kind of share with you a little bit more market data there as well. And actually, hold on one second. Let me make sure that we're okay. Okay, make sure that we're. Okay, we're going to let everybody into the Zoom room. Okay, I think everybody's getting into the session now. So my apologies. We had a little bit of a delay with the Zoom session. So I'm going to kind of do a quick repeat because I think we didn't have everybody quite in the session. So welcome to our University of Virginia Homebuyer Workshop. My name is Jason Maida. I'm with American Pacific Mortgage. Really excited to bring this content to you. This is our second installment of workshops this year in 2024, and a lot going on in the market. So the timing is great for you to join us for tonight's class. This is a very interactive session. So as we go through tonight's content, we encourage you to ask questions. We'll kind of take those questions either through the chat function in Zoom, or you can use the Q&A function in Zoom, whatever's easier for you. And, the UVA Alumni Association is, really spread all across the country. So we'd love to kind of know a little bit more about where you're joining us from. So if you can, just drop in the chat where you're located. I know many of you are probably in the DMV area, but it'll be great to kind of get a sense of where the rest of our audience is at across the country. We are a nationwide lender. We're a top 10 lender in the country. And our team in particular specializes in homebuyer education. So along with our UVA Alumni Association partnership, we work with other universities across the country, sharing more information about first-time homebuyer resources and support that can help you in your local community. All right, thanks for dropping your location in the chat. We got NYC, I see DMV, Atlanta, Charlottesville, Dulles, awesome. North Carolina, appreciate that. All right. I think I saw California mixed in there too. We got San Francisco Bay Area. Okay, very cool. That's super helpful, guys. I really appreciate you doing that. That just gives us a sense of where you're joining us from. And like I said, when we talk a little bit about housing market data, I think that would be super helpful for you, for us, I should say. A little bit about me. So I'm going to be your presenter this evening. And I obviously work for an organization called American Pacific Mortgage. If you choose to kind of start your path towards homeownership, you get a chance to work with me one-on-one to design a home buying plan for you. So not only am I going to be your facilitator this evening, but would love to personally help you on that path towards homeownership. We're in our second year of partnership with the University of Virginia Alumni Association. Really excited about all the great things to come. We've actually successfully helped first-time buyers like yourself that have started off in this class and kind of develop plans for them and help them achieve their homeownership dreams. So really cool stuff that comes out of these classes. Well, as we get started with tonight's class, and by the way, let me just mention this to everyone. We are recording tonight's class. All of our presentation material, including the video, will be up on our YouTube channel tomorrow morning. So you can kind of do a look back if you want to kind of just compare your notes from tonight's class. So we'll have all this stuff recorded for you as well. And I'd encourage you, if you get a chance, share this with your friends, family, maybe your coworkers that might enjoy this class. All right, well, here's our topics for tonight. We're going to talk a little bit about the housing market, what's going on with it. We're going to talk about interest rates. That's probably the biggest topic right now, at least, especially over these next 3 to 4 weeks. And we'll explain why in just a minute. We're going to spend some time looking at a budget analysis. What does it look like to continue renting versus what it could be to buy? Talk about credit. We're going to look at some different programs that are available to you as first-time buyers. Also speak to some of the documentation generally needed if you're deciding to kind of get on that path towards homeownership. And I do want to spend some time looking at first-time buyer programs available in the DMV area, but we can also look at across the country and kind of go through some particular scenarios. And finally, we'll talk a little bit about the buying process. So after tonight's class, you may say, hey, you know what? I want to put a plan together for myself. Maybe I'm thinking about buying a year from now or 2 years from now. We're going to kind of tell you what that path towards homeownership looks like and then the workflow of buying a house. All right. So that's kind of what we have in store for you tonight. And again, very interactive class. So we encourage ask questions. We'll do our best to take on those questions as we roll through tonight. All right, well, let's think about buying a little bit because, you've obviously taken time out of your busy schedules on a Tuesday night to spend some time with us to learn about homeownership. And it's probably going to be one of the biggest financial decisions you try to make in the next few years. And when you think about owning a home versus renting, I think there's a lot of great benefits that you may want to consider on the homeownership side of things. Now, we should be able to control affordability for ourselves, meaning we don't have to worry about our rent increasing each year that we renew our lease. This is an opportunity to create wealth, and I would say generational wealth, right? So as your home appreciates in value and maybe your mortgage balance decreases with additional payments, the difference between those numbers is equity in your home, and equity can help create that generational wealth for yourself. And it is an asset that can be shared with heirs of your estate, for example. And there's some really great tax benefits that come along with owning a home. So one of the things I like to do when we start our classes is to dive right into a budgeting exercise so we can take some of those benefits that come along with owning a home and plug that into a rent versus buying analysis. And so what we're going to do is we're going to switch screens here. I'm going to kind of start off our class with that analysis. And so you can kind of have some basic framework of what it could look like with home financing. So this tool that we're going to go through right now is our rent versus buying calculator. And this will be part of the links that you get in the presentation material tomorrow. But we've already kind of pre-filled some of the fields just to kind of keep us on track for our timeline for tonight's class. But let's kind of dive in and take a look at this. So the first thing we're going to talk about is monthly rent. So we assume a monthly rent of about $22.50 for this particular client. We have renter's insurance estimated at $15. We have the assumption that our rent will increase about 5% on an annualized basis. And then we have the home purchase scenario, which we're assuming we're going to buy a house for $450,000. We have a minimum down payment of 3%. We factor in property taxes for our monthly budget, homeowners insurance to insure our house against different, perils like, could be flood, it could be theft, anything like that would be covered under our homeowners insurance, fire, of course. And then we have maintenance costs. And then our next tab is going to be under loan information. Now, generally, we're going to be looking at what we call a 30-year fixed mortgage, so that the payment is fixed over a full 30-year term. And then we have our average interest rate, which we're going to spend some time talking about in just a few minutes. We have origination charges, and I want to talk a little bit about origination because that's important for you as a buyer. So when you elect to have financing for your home purchase, every lender will have what we call as origination charges. And those are the cost for doing business with a lender. Now, one of the benefits you have in our UVA alumni partnership is that we actually discount our origination charges by $750 to make it more affordable for you. So that is always going to be part of your financing, but we try to make those costs a little bit more reduced for you as a partner with us through UVA alumni. And then we have discount points, which discount points allow you as a buyer to obtain a lower interest rate potentially by paying more funds out of pocket. And what that means is if you pay 1 point, that's 1% of your loan amount. So let's say I'm financing $400,000. So 1 point would be $4,000. And generally speaking, that would bring down your interest rate about 0.25%. Okay. Now, in today's market, where most that are kind of entering today's housing market, I would consider that the loan that they're electing is probably going to be more of a temporary solution, because further down the road, next 1, 2, maybe 3 years out, they're probably looking at refinancing. And so many of our buyers that are purchasing in today's market, I wouldn't recommend paying points because the return on investment is like 3 to 4 years versus refinancing in 1 to 2 years. So generally speaking, we wouldn't recommend an investment in discount points. Now, we also have other settlement services. Those are going to be like title and escrow fees, attorney fees, fees for the transfer of the deed in the local county that you're going to buy in. So all of those come under other fees with closing costs. And closing costs, when you're thinking about purchasing a home, we generally encourage clients to budget 2 to 3% of their total sales price for closing costs. So when we think about saving up for a home, we have to save up for our down payment. We also have to save up for closing costs. Now, the last section is called other assumptions. So we're going to assume our rate of appreciation on this home is about 4%. We're expecting to be in this house about 7 years. And then eventually, when I decide to sell the home, we're expected to pay costs, right? Those costs will be in the form of closing costs to sell, as well as realtor expenses. Then we also want to factor in state and federal taxes, as well as the comparison to a savings rate. So if we take a look at our calculator now, so we're going to look at our monthly budget, which if we know where our rent is around $2,200 a month. Now, if we compare that to buying a house, that house payment is $3,700 a month. So we're stepping up our monthly budget by $1,500. At the same time, and this is kind of why I tell buyers, like, it's not necessarily an apples to apples comparison with ownership versus renting, is that because over the course of that 7 years of ownership, I have about a $65,000 opportunity of owning a home versus renting and continue to deal with rental costs. So while that payment is higher on a monthly basis, the opportunity over the course of that 7 years far outweighs that monthly budget increase. Now, how do we get there? Well, some of it goes back to some of the benefits we just talked about. Home equity appreciation is baked into that number, as well as tax savings with a potential interest deduction. Of course, we'd encourage our clients to talk to a tax advisor, but that's just how we want to kind of think a little bit about home ownership, is that we want to factor in all these different things into our monthly budget. Now, as we have the opportunity to get a chance to meet with you and get connected for your own home buying plan, like, we'll figure out budgets and what makes most sense for you, what the right sales price is, down payment, and then of course monthly budget based upon the prevailing market interest rate. All right, so let's kind of transition out of our rent versus buying calculator. I want to talk a little bit about the housing market, specific with the Virginia market. I know we have a really diverse group in our audience here of kind of where we're located. We're kind of all over the country, but I think that at the same time, while the median sales price may not look the same in Texas or Nashville or California, the trends in the market are fairly similar. If we kind of look at what's going on here, we got a little bit of a little move downward pressure here on price. Some of that is we have some standing inventory out there. Some of the homes that are staying on market right now, even in like a competitive market like California, we see some homes that are on the market 2, 3, 4, 5 weeks, which is a long market time, which is starting to see, values kind of creep down a little bit. I think there's a little bit of a waiting to see what happens with interest rate mentality right now for some buyers in the market, and it can delay some of the inventory moving. So I think that's why we're seeing a little bit of a longer lead time with days on market for some homes right now. I think everybody's kind of anticipating rates to decline. We're going to talk about interest rates in just a second, but I think ultimately kind of where this housing market goes is really important. Interest rates will be a big part of that. As interest rates go down, generally buyer demand will continue to increase. The challenge we have right now in most markets across the country is that we just don't have a lot of inventory in the market, whether that's new construction or sellers willing to put homes on the market as resale homes. So that's going to be the kind of dilemma we're in. I do think as we look into interest rates, buyer activity is picking up. What's interesting is that generally in the housing market, we see a pretty good buyer demand in a normalized interest rate market right around April, May. That's when people start thinking, okay, yeah, let me think about buying because the weather's getting warmer. I'm thinking about what school district my kids might want to go to. All those things are starting to become into play April, May, and then, they make decisions in the spring and summer months. But with interest rate levels being where they have been recently, that has delayed us a little bit. In fact, we really saw buyer activity pick up in July. So we're about 2 to 3 months behind kind of the historical activity levels that we see. And a lot of it's driven by what we're seeing in interest rate activity. So interest rates have started to come down a little bit. We had a high of interest rates at 8% back in October of 2023. As of the last couple of weeks, we've seen interest rate levels equivalent to about April of 2023 rates. And good signs are kind of on the horizon from an interest rate perspective. I think the mindset, again, for most buyers now is that as interest rates are declining, they do realize competition is starting to pick up out there. So we're seeing activity levels in terms of buyers interacting with us increasing as well, because I think many are feeling like, okay, I got to get into this market now because as interest rates drop, that competition will increase and then potentially move prices further up. So that's kind of how we're seeing the market right now. Now, the last thing I want to kind of talk on, which is the most important thing right now, is the Federal Reserve meeting that's coming out September 18th. And that will kind of set the course of what action the Federal Reserve will take with interest rates, whether it's a 0.25% reduction in rate or a 0.5% reduction in the federal funds rate. We don't really know until Jerome Powell makes the announcement of what they're going to do. But I think there is a pretty good indication that, given what we're seeing, weakness in the labor markets, cooling inflation, that the Federal Reserve is going to take action next month. But the question is, at what level? Now, I think the misconception that, as our class needs to understand, is that when the news begins to talk about Jerome Powell cutting rates, whether that's a 0.25% or 0.5%, that doesn't mean mortgage interest rates immediately fall to a 0.25% or 0.5%. It's not a 1-to-1 ratio thing. Many of the outcome of the reduction in the federal funds rate will be seen some weeks leading into that, with speculation on what's happened, but also kind of out of that meeting. But it won't necessarily be a direct 0.5% reduction in interest rate. I think the reality is, I think we're probably in this interest rate level of the low sixes until the balance of 2024. And then potentially we start breaking into the fives as we get into 2025. But the Federal Reserve, I believe, has like 3 or 4 more meetings this year. So this thing will be a bit fluid right now until we get more economic data. But I think there's a pretty good indication that the Federal Reserve will cut rates in September. Well, as we look at interest rates specific to mortgage, there are various characteristics that go into interest rates, like credit eligibility, the type of product I'm going to elect, what my down payment looks like. Am I going to take and pay additional expenses out of pocket to bring down my interest rate? And what does the term look like of my loan? So the longer my term is, that could change my interest rate, versus if I have a shorter term, that generally will bring down the interest rate a little bit. Now, as we meet with you for a one-on-one consultation to design your own home buying plan, we'll figure out the right path for you with homeownership in terms of what program works. And we'll look at today's interest rates to see how that matches up with your monthly budget. All right, I want to take a quick pause there. Any questions from the audience before we kind of jump into credit? Okay, and again, if you have any questions, feel free to use the chat function, or you can use the Q&A function, whichever works best for you, and we'll answer those questions live on air for the audience. Well, let's talk a little bit about credit. When I think about home ownership, there's generally kind of 2, I want to say hurdles, but things that are really kind of prominent for first-time buyers. It could be credit, because maybe we've had some past challenges with our credit, or maybe we're a little bit overextended, or it could be on the savings side. So maybe I just don't have enough savings right now for home ownership. So we're going to, as part of our class tonight, help you out with both of those kind kind of action items, so to speak. And I want to first talk a little bit about credit. And when we think about credit, there's obviously a lot of great visibility to it. Many of you joining tonight's class have tools that you can use to see what your credit score is at, whether that's through Credit Karma or some of the agency tools like Experian, Equifax, or TransUnion has. But I think it's important to understand there's various scorecards to credit scoring. Of course, when you're applying for home financing, every lender is going to use a mortgage score, which can be found through all three of those different agencies. Here's what the score calculation looks like for FICO in applying for a mortgage. 15% of it is going to be how long have I had credit? So the more mature my credit file is, the stronger my credit score is going to be. 20% is going to be related to how much new credit am I trying to access? So am I opening new accounts? Do I have new inquiries on my credit specific to hard inquiries? That makes up 20% of the score. 30% is going to be around revolving credit. And we're specifically looking at our utilization of that line of credit. So for example, if I have $10,000 in credit limits and I've exercised $5,000 in balances on that limit, that means I'm at 50% utilization. Ideally, in the perfect world, to optimize your credit score, I would want us to be below 10% utilization, or basically $1,000 in that example there. Now, when you take a look at some of your credit cards, there's always going to be two kind of key dates on those statements. One is a billing cycle date or a statement date. The other is a due date. I think it's important to understand as a buyer that when you have your credit card accounts, the data that's being shared with the agencies comes out at the end of the statement date. So what I mean by that is when your statement date closes, all your activities in that cycle gets closed out on that date, and then the credit card issuer sends all the information to the credit agencies. And so one of the tips I want to give you in to manage your credit card debt is if you can pay down the debt before the end of the statement date, you're going to lower that utilization and then hopefully give yourself an improved credit score. Many of us are in the habit of paying on the due date, and there's nothing wrong with that. But if you're trying to really optimize credit score, I would encourage you to try to pay off or pay down those credit cards before the statement date. And then the last component to the mortgage score is payment history. So that's pretty self-explanatory. How have I paid my bills? Specifically in the last 12 to 24 months are going to be the biggest impact to your score. Now, if you've had any challenges with late payments or overextension of credit, the delinquency is going to be rated as 30-day lates, 60-day lates, and then 90-day delinquencies. So that's what we're going to see in that payment history component. Now, again, we're looking at the last 12 to 24 months in terms of how it's going to impact the credit score. Things may stay on your credit report for 7 years, but that most recent 12 to 24 months is the kind of the key timeline there. Every loan program has a minimum credit score, and you can see some of those up on screen here. We're going to dive into loan programs in just a bit, but every score is going to have, every loan program will have a minimum credit score. Now, other score factors to take into consideration, bigger events on your credit report, like maybe a bankruptcy or a short sale or foreclosure, maybe collection accounts, those could have bigger, longer lasting impacts to your credit score. And then account closure is something that we need to kind of take a quick look at, because when you decide to close out a credit card, maybe you're doing a balance transfer and you're moving credit cards because this other card has really good perks to it. Just be careful that when you close out the old credit card, that it doesn't impact you financially on your credit score. And what I mean by that is if you've had a credit card for, let's say, 10 years and then you completely close out that score, now you've eliminated 10 years worth of history on your credit bureau. So it could impact length of credit. And then it also can impact your utilization of credit because now you have one less credit limit available to you. And then finally on this screen, I want to just highlight that in lending, we always look at all three scores from each of the agencies. So Equifax, Experian, and TransUnion. However, we do take the middle score between all three scores. So if my highest score is 780, my middle score is 760, and my lowest score is 720, 760 is the score that we use for qualifying, both from an interest rate program as well as mortgage insurance for the home buyer. Now, if my partner is going to join the application, let's say my partner is at 740, 720, and 700. Well, my partner's middle score is 720. So from a qualifying standpoint, which impacts also the interest rate, and mortgage insurance, and loan program, we would have to use that 720 credit score that my partner has. Okay, so we always look at the lowest middle score between both borrowers. Now, this matrix will kind of show you how long some of these events on your credit report will stay with you on your credit report. Now, again, most recent 12 to 24 months, the bigger impact to the score. But as we kind of go further away from an event, like let's say I had a late payment back in October of 23, as I move further past that, so once I hit my year anniversary of that later this year, I would see organic growth in my score. And then of course, when I get 2 years out, I should see better score. All right. Now, one of the things that shows up on credit scores is student loans. And I know student loans obviously are back in repayment. Some of you joining tonight's class may even have forgiveness of student loan debt. But there's generally three statuses for student loans. It could be active repayment, it could be forbearance, or deferment. So whether you're in one of those three statuses or not, we do have to count a minimum payment for qualifying purposes. So if you're in active repayment, that's pretty easy. But if you have an income-based repayment, we can use that amount. But if you're in deferment or forbearance, we do have to take either 1% of the aggregate balance as the qualifying payment, for a conventional loan, I should say, and then 0.5% of the aggregate balance for an FHA loan. So here's what it would look like if I'm, if I have $75,000 in student loan debt and I have an income-based repayment amount, and let's say it's $250 a month. Well, then in lending, I can use that payment from a qualifying perspective. But if I'm back in school and I'm working on, my master's program and, I still have some student loan debt that's in deferment because I'm in school, if I'm going to apply for a home financing, then the lender, we would still have to count a minimum payment, even if those loans are in deferment. Okay. Now, the cancellation of student loan debt, if that's still pending for you, but you have documentation of it, if you send that to us, then we can exclude the student loan debt from the qualifying. All right. All right. So all student loans, credit, some of the stuff that we've already kind of talked a little bit about in tonight's class, all kind of ties back to the available loan programs that you have as a first-time buyer. And there's a variety of different characteristics and guidelines that go into each one of these programs. So what we'd like to do in our classes to kind of give you kind of a high-level look at each one of these programs. And then as we have the opportunity to meet with you for a consultation, we'll kind of figure out which resource is going to provide the best support for you in achieving homeownership. So let's kind of dive in and talk about the first one, which is a conventional loan. You may have already even heard about a conventional loan. So that has to do with Fannie Mae and Freddie Mac. Conventional loans occupy about 70% of all originations across the country. Generally, it has a minimum credit score of 620 for the conventional loan product. You can put down as little as 3% using a conventional loan. And Fannie Mae and Freddie Mac set loan limits annually on their programs. Now, the conforming loan limit all across the US is 766,550. So that's called the conforming loan limit. Now, I know we have some of you joining in from NYC and California and some of our DMV area markets too, where you have what we call as high cost of living areas. And what that means is that Fannie Mae and Freddie Mac will allow loan amounts to stretch beyond the conforming loan limit as high as like $1.149 million, depending on how the cost of living of your market looks. But when we do that, that minimum down payment jumps from 3% to 5%. That's called a high balance loan under the conventional guidelines. And so that's another alternative for clients that are looking to purchase in kind of higher, more expensive markets. And the conventional loan product, as I mentioned, has that minimum credit score of 620. When we're going to do a little bit of a comparison to FHA loans, the conventional loan is going to look for kind of on-time credit history, especially in the last 12 to 24 months. And then we'll talk about mortgage insurance in just a bit, but as you're going to learn in a few minutes, that on a conventional loan, when you put less than 20% down, there is mortgage insurance. So if we're going to be electing maybe a 3% down option, there will have mortgage insurance tied to that loan program. The FHA product is a government insured loan. FHA stands for Federal Housing Administration. Minimum down payment of 3.5% for that product. Very similar loan limits as we see in the conventional product. But the loan limits for FHA will vary by county. So depending on what county you're in, there will be a corresponding FHA loan limit. Some of our lower cost of living markets, we could see that FHA loan amount dip down to as low as 400,000. So depending on if you're looking for that product, we'll obviously see which county matches up for your loan amount. There's a minimum credit score on the FHA product of 580. FHA, as compared to the conventional loan, has much more flexibility from a guidelines perspective. So if I did have a challenge with maybe one of my credit card accounts in October, maybe there was a late payment, FHA would have a little more flexibility around that, even though it's a late payment in the last 12 months, whereas a conventional loan might be a little bit more difficult to work around that. All right, we had a question in the chat before I hop into the veterans home loan product, and that is, if someone has the ability, is it better to put more money down or buy down your interest rate for your home financing? So it really is do we put more money down or do we buy down our interest rate? So that really depends. You're going to get more mileage in terms of lower monthly payment if you buy down your interest rate, because and it depends on how much cash you're talking about putting down, but you generally get a better improvement in payment by buying down the rate. But to my point earlier, I don't really believe in buying down interest rates significantly now because the break even's 3 to 4 years out. I would probably say investing right now in a larger down payment probably makes a little bit more sense, because then you create a better equity position so that when you come to refinance in a year or two down the road, you have more equity in your home and then you haven't outlaid all those funds for buying down your interest rate. All right, great question. Let's talk about the VA home loan for our veterans that have eligibility. So what's really great about the VA home loan, it's a 0 down payment option, a lot more flexibility from a credit scoring perspective. Credit scores down to 620, flexibility in looking at income versus expenses for the veteran. And with the 0 down payment option, you can go beyond like $1 million in total loan amount for our veterans. So there really is not the conforming loan limit situation that we have with conventional and FHA loans, and of course available all across the country. And for our veterans, there are different aspects in terms of the expense structure. If our veteran has any type of partial disability from the VA, there's what we call as a VA funding fee that gets completely waived from that product. But the VA home loans are great opportunity for our veterans that have that eligibility. And then off to the other side is our USDA product. That's for clients that are choosing to buy in more rural areas. USDA stands for the United States Department of Agriculture. So there's rural available resources that are available to you in those rural markets. Very similar to the FHA product. We're going to go up and have the county limits will be set based upon where we're going to purchase. Generally, that's going to be around that 766 mark. USDA has 2 expense structures to it. There's what we call a guarantee fee for USDA, which is 1% of the total loan amount. Plus, there's a monthly fee of 0.35% of the total loan amount. And then we kind of divide that by 12. But the USDA product can be a really great tool. There also is 2 qualifiers to USDA. There's geography, so it has to be in a rural designated area. And then there's household income limits based upon the area that you want to purchase. And then finally, the jumbo loan, which quite honestly is not super popular for a lot of our first-time buyers, can be a resource for you, but it does require elevated down payment. And then we also have to save for down payment at a higher level plus closing costs. There's also another asset requirement with jumbo loans. You have to also save up reserves, which reserves basically mean is money that I have left behind after I've contributed my down payment and closing costs. Usually that's 12 months equivalent of my monthly payment. So if I have a $7,000 mortgage payment, 12 months of that would be $84,000 that I have in additional assets. All right, and then question popped in the chat, which is, what is the definition of a first-time home buyer? My parents bought a condo for me to live in, and because the HOA prohibited renting at that time, they made me a 1% owner on title. So the definition of a first-time home buyer is someone that hasn't owned a home as their primary residence in the last 3 years. So in your scenario there, technically, if you have even a 1% ownership in the condo and you're living there, then you would not be considered a first-time buyer. Now, I could have a rental property that I've owned for the last 10 years, but I'm currently renting my primary residence. I would still be considered a first-time buyer in that scenario. Okay. All right. Awesome. Thanks for the question. I want to explain PMI to you, and PMI stands for private mortgage insurance. And what that insurance does is it protects the lender essentially of default from the buyer. Now, there's PMI, which is private mortgage insurance for conventional loans, and there's government insured mortgage insurance, which is on an FHA loan. So let me kind of dive into each one of those for you. Conventional loans have various payment options for PMI. You can pay it monthly. You can pay it split MI, where some of it's upfront, some of it's on a monthly basis. You can take and basically buy out the mortgage insurance. We call that single premium. And there's also lender paid mortgage insurance. And that's where you take an elevated interest rate in order to buy out the mortgage insurance in its entirety. Now, PMI is calibrated based upon what your credit score is, what your down payment is, and how much you finance. So, some of you in tonight's class have already been doing some searches on Zillow or Redfin and maybe using their calculator functions. You're probably not going to get a very accurate mortgage insurance number because it doesn't have these characteristics built into it. So mortgage insurance on a conventional loan, especially if you're a higher credit score customer, can be really affordable and might change your mindset in terms of how much you think you need to really save up to hit your budget goals. Now, the other aspect of conventional mortgage insurance is that it does have a cancellation component. So once I have 2 years in that loan and I reach 20 to 22% equity, I can apply to have the mortgage insurance canceled. So if we look at an example of PMI, and I have one here on screen at the bottom here, if you took and financed $450,000 on a conventional loan, you had a credit score of 740 and a down payment of 3%, your mortgage insurance is about $183 a month. So a lot cheaper than you're probably going to find online when you're doing some of those calculators. Now, the higher my credit score is, the higher my down payment is, that mortgage insurance will continue to decrease for you. So one of the things we do with clients during their home buying sessions is figure out where we're at from a credit score perspective. Is there areas of opportunity to increase that credit score? Because if I can lift the credit score and lower the mortgage insurance, maybe my buying power looks a little bit more favorable for me as a home buyer. All right, and then let's talk about FHA mortgage insurance. So it is government insured mortgage insurance. There's two components to mortgage insurance with the FHA loan. There's upfront mortgage insurance, which is equivalent of 1.75% of my loan amount. There's also monthly mortgage insurance, which is 0.55% of my loan amount. So those are set on that product. Now, one of the big things with FHA mortgage insurance is it cannot be canceled. So even if I have, 22% equity in my home, it will not allow me to cancel the mortgage insurance. The only way I can exit mortgage insurance is if I refinance from FHA to a conventional loan product. Now, if we look at the FHA mortgage insurance calculation, take that same loan amount of 450. Now, because there is upfront mortgage insurance, I have to add that on top of my total amount financed. So that adds 78.75 to my balance. And then there's the monthly mortgage insurance, which is 206 per month. Okay, so that gets also added as a monthly basis. So as you can see, when we draw the comparison, FHA mortgage insurance is going to be a little bit higher. But I think it's important to understand as a buyer that if we have to use FHA as a tool for us in home buying as maybe short-term access to home ownership, the reason why we're doing that is because it's going to add a little bit more flexibility in the FHA product versus a conventional loan. So going back to my example, if I had a late payment on a credit card in October, it might be a little bit more difficult with a conventional loan, but maybe with FHA, I'll have that flexibility to still achieve home ownership, use FHA as a springboard into home ownership, and then maybe 2 or 3 years down the road, look to be able to refinance into the conventional loan product. The last thing I want to kind of touch on with FHA loans is that if you've been doing searches online for interest rates, you're generally going to see FHA rates are slightly lower than conventional rates. So it may draw your attention because you see that lower rate. However, as we've kind of explained here, the expense structure on an FHA loan looks a lot different than a conventional loan. And so while it might look more attractive from an interest rate perspective, when you add the expenses, FHA, if you're a qualified conventional buyer, might not be necessarily the right path for you. All right, I'm gonna take a question and then we're gonna keep it moving here. And the question is, how does the first-time home buyer program work if you're buying as a couple? My wife would qualify as a first-time home buyer, but I currently own a house. So that just the distinction differs by state. So I don't know what state you're looking at, but the rule, for example, in California, for example, as a first-time buyer, if you're currently living in the home that you own along with your wife, and then because you're in the same household and you're a current homeowner, then she would not have a first-time buyer designation. Now, if that home that you own is an investment property, you're not currently living in it, then if you haven't lived in that house for 3 years, then you would have the first-time buyer designation. All right. And then we can take that question offline too if we need it. There's a little bit more detail that I need to know, but that's kind of how I would see that initially. Okay, I think we answered that. And then the question is, what if you haven't purchased, but your partner has, does that impact? So I think it's kind of the question I just answered. It could, depending on the state, it could depend on what your relationship status is. But if you're going to apply, generally speaking, as a first-time buyer, if your partner is not a first-time home buyer, then most programs are not going to let that partner be a part of that first-time buyer program. Okay. All right. Thanks for the questions, everyone. We'll keep them coming. We'll get those answers out to you. Let's talk a little bit about documentation when it comes to home ownership. So if you're thinking about getting on the path to home ownership, I like to kind of talk a little bit about income and some things that we want to start preparing behind the scenes. So if you're a W-2 wage earner, generally you're going to want to get together the last 2 years of W-2s, your last 30 days of pay stubs. And then as part of our lending process, we always do a verification of employment, usually towards the middle and end of the process. So that's generally speaking what W-2 wage earners need to gather. Now, if you're self-employed, it's a little bit more labor intensive. So we do need the last 2 years of tax returns, usually profit and loss statement. We don't need that necessarily right away, but eventually we'll need a profit and loss and a balance sheet. And then we usually need a CPA letter or some type of way that we can verify the existence of the business, basically how long that you've been in business. Usually as self-employed individuals, you have to have 2 active years of tax filings in order to use that income for qualifying. Well, speaking of 2 years, in fact, I just took this question yesterday from a prospective client. A lot of misconception out there is that I have to be on my job for 2 years to obtain home ownership, which just isn't the case. So it does require that you have 2 years of employment or educational history. So the example I like to use for a lot of our alumni workshops is that if I graduated, let's say in the spring, and I've been at UVA for 4 years, and now I just took on an accounting job, and that's the field I studied in, even though I'm just starting my job, since I have my 4-year education behind me, I would not need to have 2 years on the job for qualifying. Another example we get quite often is that clients that are in job transition, right? So I'm working on my job, I've been there for 2 years, but I have a new job opportunity. The question comes up is, can I use that new income for qualifying? The answer is yes, as long as we have an executed offer letter, and then we can better determine like when the start date is of that new job. Now, if you have variable sources of income streams within your job, so let's say I have a base salary, but I also have commissions or bonuses. In order to count those variable sources of income, we do need to see 2-year history of getting those sources, because as an underwriter or within the underwriting guidelines, they want to see some type of track record, a history of those earnings. Sometimes questions come up like with RSUs, so restricted stock shares that you can achieve or earn from your employer. Those can potentially used as income streams if needed. But to that point earlier, if it's a variable source such as that, we do have to show that someone's been on the job for at least 2 years. All right. Now, sometimes where that 2-year rule can get a little bit more challenging is in dual employment and situations. So sometimes clients will have job situations where they work maybe 30 hours at one employer, 40 hours at another. In order to count both sources of income, then I have to just show that I've been on both jobs simultaneously for the last 2 years. All right. Now, the last thing I want to kind of touch on before we leave the income section is that if you have other sources of income, let's say Uber or Lyft that you're doing on the side, in order to count your full-time job plus those supplemental income sources, I do have to show that I've been on both jobs for 2 years or been doing both simultaneously for 2 years. And the last thing I actually want to touch on is if you have other income coming in from maybe a partner or maybe room and board or something like that, those sources generally can't be counted. If your partner's income wants to get, if we can want to include your partner's income to the qualifying, then generally we would have to have your partner as part of the application. All right, and then with income, we always do a expense versus income ratio analysis. We call that the debt to income ratio. And what we're looking for there is we're taking a look at bills that typically appear on your credit report, like personal loans, credit cards, student loans, auto loans, comparing those versus your pre-tax income. Generally, we don't want to see those expenses exceed more than 43 to 45% of your pre-tax income. So on screen, you can see kind of that formula: principal and interest, property taxes, insurance, and then PMI, that private mortgage insurance. If I've elected to purchase a condo or a townhouse, HOA expense, and then those monthly debts. So in this client scenario, we have $3,000 in debts versus $8,500 in income. So we have a client that has a debt ratio of 35.29%. So many clients will ask me, like, Jason, what do you think the debt to income ratio should be? What's your recommended mark? I would say, in meeting with so many clients, I think the comfort zone I see is about 33 to 36%, generally speaking. But everybody's situation is a little bit different. This metric helps us from a qualifying perspective. It doesn't indicate affordability because we're only seeing things that appear on your credit report. So as I get a chance to meet with you one-on-one to go through your own home buying plan, we're going to talk about affordability. What does that look like for you? Because there might be other expenses we can't see. And everybody has a variance tolerance level of what affordability looks like for them. All right, quick question that came in for us, which is, if you're primarily a W-2 earner, but do 1099 work on the side, can you use both of them to show your income from both sources? Okay, so I think I hit on that a little bit, but I want to just detail out a little bit more. So yes, you can use the 1099 income, but you do have to show that you've been on both jobs for 2 years. So my full-time job plus the 1099 work. Now, 1099 means that you're an independent contractor and you get a 1099 statement that you use to file with your taxes. And you'll file that under Schedule C with your taxes. And so let's say, for example, I have a $30,000 1099 that I receive. That doesn't equate to $30,000 in income, because if you've written off expenses to that 30,000, it might be less. So just something to kind of keep in mind. And obviously we'll help you, coach you through that as we work on home buying plans for you. All right, the last topic that we're going to focus on before we go through the workflow is kind of just assets or savings for homeownership. You heard me talk about two kind of challenges for buyers: credit or savings. Well, now we're going to talk on that second piece of things. So when we think about savings for homeownership, we generally need to save up for down payment as well as closing costs. Closing costs can be anywhere between 2 to 3% of our estimated sales price. And then we have our down payment that will vary based upon loan program. Now, there's various documentation sources that we'll need to verify those assets: checking accounts for the last 60 days or savings accounts. You can potentially tap into 401ks or 403bs. I would just encourage you to talk to your tax or financial advisor before you access those assets. And then family can also contribute to a home purchase. There is no minimum contribution from the buyer. We've had family members that contribute the entire assets for a transaction. Those are called gift funds. There is no seasoning requirement for gift funds in a home purchase. Now, being that savings tends to be a bit of a challenge for buyers, I like to give you kind of an exercise or maybe a discipline that you can put in your own finances. And it's a really simple approach to savings. And so, as we meet with you for your home buying plan, we're going to talk about, what are you paying for rent? What do you think your budget looks like for home ownership, right? So if I feel like, first of all, if I'm at $2,000 a month in rent and I feel like I can pay $3,000 from a mortgage perspective, well, let's say $3,500, right? Well, if I can start building my savings and start paying my savings account like I'm making a mortgage payment today, that's going to help me accrue better savings over time. Here's what I mean by that. So the first of the month comes, you got your $2,000 a month rent. What we would want to do is create the discipline for ourselves to pay $3,500 essentially, but $1,500 goes into our savings account on a monthly basis. So we paid our $2,000 rent, plus we got $1,500 going into potentially a high yield savings account. After 6 months, now I've accrued maybe $9,000 in savings. At the end of the year, that's $18,000 in savings, not even including interest at maybe 3 or 4%. And what that's going to do, it's going to be two major things. One is it starts getting your savings up to a level that can allow you to access homeownership hopefully a lot quicker. And two is, I think it really kind of creates a cool little discipline, which is basically allowing myself to really understand that how my finances are going to feel by paying that additional $3,500 or paying that additional $1,500 a month for a total mortgage payment of $3,500. All right. So that's kind of a savings plan approach that we always talk to with our buyers. Now, we understand the challenges with savings. It might be a little easier said than done. That's why there are first-time buyer programs also available to you as first-time buyers. And they're in different states across the country. Usually each state has what we call as an HFA, which is called a Housing Finance Agency. Virginia Housing has their own agency designated to support those buyers. And usually it's low to moderate income buyers. each state has a various kind of distinction of what a moderate income buyer is. And then usually a low income buyer is someone that makes less than 80% of the median income. So here's some of the products in the state of Virginia. Obviously, if you're in the DC area, you're in Maryland, there's other programs through those different housing departments. I know, some of us are from NYC and Texas and Colorado and California. There's going to be agencies available for you, each one of those products. And we can talk a little bit about those offline. But with Virginia Housing, there's some flexible down payment options through that product. There's lower PMI that can be achieved with the Virginia Housing product. And there's various DPA grants. So DPA stands for down payment assistance grants. Those can be anywhere between 2 to 2.5% of the purchase price. So when it is a grant, it doesn't have to get repaid. That's generally going to be for some of our low income housing buyers. And then Virginia Housing also has the plus second mortgage, which will provide you up to 3 to 5% of your purchase price that you can use towards down payment and or closing costs. And each state is going to have a variation of those type of resources available to you, but the qualifying parameters might look a little bit different. I've included the income limits by county for the state of Virginia. So if these products look appealing to you, we'll certainly talk through those with you during a consultation with you, but that's kind of what the income limits look like. Most programs are set by a application income limit. So if I'm applying for the program and I'm going to look in the Arlington area, I couldn't make more than $145,000 as an applicant. All right, before I dive into the workflow of buying, I want to just take a question and then we'll almost be to the finish line here. The question is, if I want to see what dollar amount of loan I would qualify for, will my credit be pulled and affected? Just to answer that question, which we'll hit on a little bit later. So when we start building a plan for you to figure out what you're eligible for home ownership, we access credit because it does change what product we can offer. However, it's a soft credit check, which soft credit check is really important because it doesn't impact your score at all. So, and the reason why we do that in our approach is because most of our first-time buyers are not going to run out this weekend and buy a house. It might take several months or maybe even years to achieve home ownership. So we want to get a baseline for where you're at in terms of credit because it will change eligibility, but it's not going to impact your score. All right, great question. Let's talk about the buying process. You've heard me mention a few times about the consultative process, which that's, attending tonight's class as a follow-up or next steps from this class would be scheduling a consultation with us. Now, after we meet with you for a 30-minute session, if you decide to get pre-approved, that's what comes out of that session. A pre-approval means that you have eligibility to basically get financing and start making offers on homes. That pre-approval is good for 60 days, but it can be recertified at any time. So you don't have to feel like you have to run out and buy a house right away. That's not the purpose of the pre-approval. The pre-approval gets adjusted based upon your home search. So you may have a pre-approval amount of 500,000, but maybe your comfort zone of home is 425. That pre-approval can be adjusted at any time. So that's step one in the process. Step two is going to be the house hunting phase. That's where we get a chance to go out and look at homes. Generally, that'll start online. So you're going to be doing some searches just to see what's in your budget based upon your pre-approval parameters. And then we would encourage you to get connected with a local realtor that can help kind of show you different homes that fit your price range. Now, many of you have probably heard about the National Association of Realtors lawsuit settlement. They kind of changed the way commissions are structured for realtors. And so that's something as you interview a realtor, we'd encourage you kind of ask questions about that because that does change a little bit about how they serve. But realtors are there to help support you in your journey towards home ownership. They're there to help negotiate contracts. They're there to help not only find the house, but help make sure that everything kind of remains in line for you with your home ownership goals. Now, if you find that right home that works for you and you submit an offer to the seller, and if the seller accepts your offer, then we move to step three, and that's called entering escrow. So that means you have a ratified contract with you, yourself, the buyer, and the seller. And that contract will stipulate timelines for the transaction, when the transaction is going to be completed, how long you have to do your due diligence on the house, and I'll explain what that looks like in just a second. But the same day you go into escrow, you're going to get a call from us, myself, and say, congratulations. Now you have an accepted offer, and I'll explain to you a little bit more about next steps at that time. And we'll also schedule you for what we call as a follow-up video session. And during that video session, we spent about 30 minutes together talking about your current interest rate availability based upon the market, which will be super important, monthly payment, out-of-pocket expense, timelines of the transaction, just so you have a good picture of what to expect next. Now, within a couple days of the transaction, you will be expected to make what we call an earnest money deposit, which is usually 1 to 2% of your purchase price. It will be a contribution that you put into the transaction, but it does count towards your down payment and/or your closing costs. And that deposit is generally protected by provisions called contingencies. And that contingency allows you to do some investigative work on the property. You get a chance to get the house appraised, you get the house inspected, you get your loan approved. All of those things happen and your deposit is protected during those timeframes. Because as a buyer, you want to make sure this is a good, sound investment for you. It may be all exciting and everything's great when you first get the accepted offer, but we also want to make sure that you take the time to do your investigative work to make sure there's no potential pitfalls for you with this new home. Now, step 4 is going to be some of the administrative tasks that we do behind the scenes in lending, like verifying your assets or employment. Maybe it's updating your credit file. And then the rate lock happens during the process. Now, it doesn't necessarily happen at step 4. There's a variety of different stages that could happen. The rate lock is when we lock in your interest rate for the interest rate you're going to be given. And there's strategy to that, especially in today's market where, we're pending Federal Reserve rate cuts and different things going on in the economy. So there is some strategy doing that. One of the things that I always consider experts on is really analyzing the market and trying to give our clients the best tools to make a decision when to lock in that rate. So there's definitely some strategy implemented there. Step 5 is going to be about 3/4 of the way through the process. That's when we have loan approval back from the underwriting team. We generally have the appraisal back to make sure the value is supporting what the purchase price that you're making for the home. And then you probably have your inspections back by that time. That also probably gets you to the end of your contingency period. And at the end of the contingency period, that's when you'll decide if, hey, everything checks out and I want to move forward or not. And when you do, then you can sign off on your contingencies. We're also going to deliver to you a final closing disclosure at step 3. It basically gives you a 3-day cooling off period before we get to the very end of the process called closing the loan. And just so you know, everything done in the transaction generally is all e-signature documents. However, when we get to step 6, that is kind of the final stage. There are aspects of the step 6 that do require in-person documents to be signed by a public notary or like an attorney in your state. Those are the final documents. You're signing, deeds and loan agreements. That process of signing usually takes about an hour or so. That same day, you'll actually be depositing your final funds for your home purchase. And then as a lender, once our audit is completed, we'll wire in the final funds for your home financing. Those funds will be all reconciled by an escrow or attorney team. And once those monies are all settled and distributions are all set up, then documents get recorded with the local county recorder's office. They record a grant deed that transfers ownership to you as well as a deed for the home financing. And guess what? Once everything is confirmed as recording, I get a chance to give you the best call of my day, which is to say, congratulations, you're now the new homeowner, and get a chance to celebrate with you. I made 3 of those calls today all across different parts of the market, and it's the best part of my day because, people are just overjoyed because it usually starts with this class, just trying to figure out like, what's this all look like? Meet with us for a consultation, design a plan, and then start your home search, and then eventually get to the end of the finish line. And again, that's just the best part of the day. Now, if you're thinking about moving forward in the process and want to kind of put your own home buying plan together, we'd encourage you to check out some of these links. And it's a really simple process. We had the question answered or asked earlier. It's a really easy online application. It's only a soft credit check, so you don't have to worry about your score being impacted. You then upload proof of income and assets, and we're going to meet one-on-one for a video session and just to design a plan. So whether you want to buy this year or in 24, 25 or 26, at least you'll have all the tools and resources you need to make a good financial decision. Here's what the consultation looks like. These are kind of all the aspects that go into it. Where do I want to buy? What's maybe the purchase price I'm looking at? What's my budget need to be? How much is my savings? Is it adequate? Do I need to work on a savings plan? All those important conversations that we're going to have as part of a consultation. And we have other resources that are available to you, like our mobile tools. You can download for Android or Apple. You can start your application process right there via mobile. It also sends push notifications to you. Really great tool. I think what most of our clients use it for is the calculator function, just to get a better sense of certain payment levels based upon some of the homes they're seeing as they're going out searching for properties. Well, as we're coming to the end of tonight's class, I again want to thank you for being a part of this class and allowing us to share this content with you. We're overjoyed to be partners with the UVA alumni, and I got a chance to get on campus last year. I'm going to make my way out there again in October just because it's a great place to be. I love to be in Charlottesville. It's just awesome. So I appreciate you guys being a part of this class tonight. We have other partnerships that are available to you, our communities as well. So if you, like I said, if you have friends, family, coworkers that would love to check out this content, they can always go to our YouTube channel and see recorded classes. We also have like 30 more live classes that we'll be doing for the balance of 2024. If you want to get connected with me after tonight's class, here's all my contact information. So feel free to get connected with me through one of those means. We also have some good content we're trying to put on our social channels, not just the recorded version of on the YouTube channel, but our Instagram, giving you some other resources that you can have as first-time buyers. So we'd encourage you to check out J Maida Mortgage on Instagram as well. So as we're at the top of the hour, I'm about a minute over schedule, but I do want to carve out any time for any questions from our audience. I know we've had a lot of good questions throughout tonight's class, but want to just make sure we touch on anything that didn't get answered tonight. So if you do have some questions, either drop those in the chat or you can use the Q&A function. I'll take a look now. I think we're current on what questions. I had one. Let's see. Okay, one question is, what's a good estimation of house valuation that we should look for? We look into 3 to 4 times. Okay, let me ask this. Let me look at this question again. What's a good estimation of our house value loan that we should look into? Should it be 3 to 4 times of our annual income? Okay, so I think that question is centered more around budget. So, I think looking at your income versus like your monthly payment, I would say, ideally, probably a third of your pre-tax income should be going out to the housing budget. But again, everybody has a variant tolerance level, so it just depends. Like I said earlier in our debt to income ratio conversation, like the comfort zone is usually like 33 to 36% debt to income ratio. But I think, that conversation is going to be in a consultation where we're talking about affordability. There's 2 big goals for us with homeownership for each of you, which is affordability, because that's super important, especially in challenging markets, but it's also sustainability. So we want you to be able to grow into homeownership over time, use this home maybe as your forever home, but more than likely, it's probably going to be your stepping stone home into the next second or third home down the road. All right. Any other questions from our audience? Okay, I think we did it. All right. Well, if I'm missing anything or I didn't get your question answered, feel free to just reconnect with me after tonight's class. We'll be around. We'd love to get connected with you for your consultation and help provide any resources you need on your path towards homeownership. Have a wonderful evening. We'll look forward to seeing you soon. Good night.